What's going down, investors? It's July 18th, and this is the video like it takes 30,000 to a million. After I review the account, show you all my positions, show you the investment tab, show you the option positions, my ratios, and the relative performance to the market. I'm going to tell you how to make money in the markets. Like, really, I'll tell you how. I mean, I'm not going to do it for you, but I will tell you what I believe is the right thing to do. And I'll share with you some approaches that you may want to consider if you're still in that exploration stage of your investing life. So, first of all, before I even go into the account, I'm not like a trading guru. I've been in the markets. I'm just an investor like you, no different. I've been in the markets maybe like 18 years, something like that, a long time now. And I'm just sharing my experiences, my journey. Don't take what I say as any like hardcore advice or anything like that. I'm just sharing what I've learned, and that's it. So first, it's the markets. I'm sorry, the account. So, all right, there we go. Sorry, I have to adjust it a little bit. Okay, so I'm sitting at 182,707. It was an interesting day today because I was actually up into the almost 189,000. I was up 2.51%, but the market tanked. The main reason for this was actually Apple, because Apple announced that they're going to be doing some slowing in hiring, preparing for recessionary forces. So that's interesting. Everybody and their mother, every company is expecting recession. So they're slowing or reversing hiring. Very interesting. Okay, so here are the options positions. The option positions are much larger than the equity positions. I'm going to scroll through the options really quick. You can pause at any time to try to figure out the exact positions. All the information you may need is contained in this little box right here. So here we go. I've sold a lot of new positions today, Monday. I got really lucky on the Goldman Sachs call sell. I may show you that in a little bit. And I got rid of my DD position because I already know what happens to the Chinese ADRs when they get delisted. They go OTC, over the counter. So, and you can only sell them, you can't buy them, whatever. So I sold mine, doesn't matter. It's just 10 shares anyways. And now I literally have only 6 stock positions in the account. It's the fewest I've had in quite some time. I think 5 was the fewest I remember in recent memory. Anyway. So Apple was down over 2%, unfortunately. I have 830 shares of that. I sold a call for like $25 to try to, lessen the blow by $15. So that wasn't much. You can see that $15 gain right here, but it's fine. Another $5 to go. The earnings are coming out in like 10 days on Apple. It's going to be very interesting to see that number. I mean, I'm really curious. It's probably going to be, weaker than the previous one and probably stronger than the next. But I'm actually expecting a really, really huge, like, I'm talking like blow your face off January quarter, whenever they report after the Christmas holiday season, right? I think the sales are going to skyrocket with the new phones. Like, I know I'm going to be upgrading. I've been looking for that notchless look for quite some time now. So I'm going to enjoy that. I'll probably be getting the Pro Max or whatever. I'm still rocking the 11 Pro right now because I'm big on visuals and design, and so I have not upgraded ever since this phone right here because the visual upgrades just were not big enough for me to try to buy a new phone. So I still have this one, and I'm happy with it. Actually, sorry about that. It actually still works fine. Sorry, there's a bunch of fingerprints. I don't have a plastic screen or anything like that. There you go. Well, still bad. Anyway, so I'm thinking of upgrading. It's going to be like 3 years since I've upgraded my phone, so it's been a while, and I'm really looking forward to that new look. All right, next on the chopping block here is Realty Income down 1.2% to Main Street Capital 1.2 up. Goldman Sachs was actually up quite a bit during the day. It was all the way up at 309. It was up 5.27%. At which point, I actually automatically executed before I went to bed last night. Okay, this is how lucky I am, right? This is the luckiest trade I've ever had. Well, actually, we don't know. I could be less lucky if Goldman Sachs ends up being over 310 by the end of the week. But just as a day trade, I didn't exit the trade, but just today, anyway, I set a call sell trade last night before the market opened, and as soon as the market opened, for some reason, Goldman Sachs, shoots up to 309. Okay, over 309, and I set the call sell for $500 at 310 strike price, and it actually executed. And so look at this, within a day I've already collected, not collected, but I've already erased $371 of premium. So I'm up 75% on the position just today. $371. That's not bad for a day's work. I could theoretically exit this and hope for a better entry point later down in the week, but I don't think so. I think I'm just going to hold on to this just in case Goldman Sachs keeps drifting lower and this turns out to be a negative week, which is highly likely. Moving on down, Paramount continuing the downwards drift as usual. Very interesting action here, dropping down under $24, finishing at $24.50. I'm hoping for this to reach $30 at some point, which is kind of like my ceiling, and I'll probably start selling some more puts if it goes down to like 22. So I think this company is extremely undervalued, especially on the relative basis. I did a Netflix video. Oh no, not Netflix. Disney. I did a really long Disney video. Sorry, it's like 37 minutes. But I compared all the streaming companies to each other, like 4 of them, and I did a relative valuation comparison. And Paramount is just by far undervalued. So I encourage you to go and watch that if you're interested. All right, moving on. Hopefully this one is not 37 minutes. Okay, Smith & Wesson. I actually sold some more puts here at Smith & Wesson. It's trading around $13 right now. I sold like 5 more 12.5 strike price puts going out into August 19th. So about a month away. So hopefully I collect $250 off of that. Basically, I'm trying to slowly build a position, but I will exit at $15 if it goes up to 15. I'm gonna exit around there. Hopefully, I'll have the chance to. So that's the account. Let me see the investing tab here. I have reduced the margin down to 68%. Now you're gonna double that number. It's 34.11, but 68% margin. You double it because at 50%, that's 100% margin, right? Half your account is borrowed. So I don't know why Robinhood does it this way. But anyway, so that's cool. Reducing margin by a little bit, great. But I've sold some puts, so exposing myself to potentially grabbing some more margin. Relative performance. Well, here we run into some interesting numbers, right? 1 day performance minus, 0.8. Well, let's just go with today's because I know I beat the market by a little bit today. But the after hours I'm losing, I think. So minus 0.75. Let's just quickly see what the SPY is doing. Minus 0.82 so I'm beating it by a tiny margin. But after hours, S&P is up and my account is down, so that's that. But let's look at some other time periods. 1 month, I think my 3 month is bugged, so we may skip that one. So 1 month, I'm up 2.71%. And the S&P 500, or was it 1 week, sorry, is down 0.17. 1 month, S&P 500 is up 2%. And I'm up 10.6%. So huge crush on the market here. I'm outperforming it by 8%. Market's up 2, I'm up 10.6. So that's terrific. Let's go to 3 month. Oh yeah, it's bugged, so whatever. But on the phone, I don't think it's bugged on the phone. Let me see what it is on the phone. Don't go anywhere. All right, let me see. 3 months. Okay, the phone is not bugged. So 3 months is 3.87. Let me see if you can see that. Maybe not. Maybe you can. I don't know. 3.87. And let's see the S&P 500. I don't know why the phone looks so greasy on the camera. It's gross. Gotta clean it. 3-month. Look at this. Down 12.53. So on the 3-month basis, I'm outperforming by over 15%. 15% outperformance on 3-month. I'm loving it because I was underperforming a little bit last year towards the end. 1 year minus 10.13 for the S&P 500. I think this is the big one. 1 year for me, up 9.48. So outperforming by 20%. So I'm really, really happy about that. I'm able to keep my account basically alive, almost on par. The high of the year was 201,000. So I'm basically down 10% from the high. And I'm about even on the year since January 1st. So let's see if we can find it here. January 1st. Yeah, so there we go. I finished the year at 183, 148. I'm at 182, 700. So down $500 on the year. Basically even. So I'm really happy about that. In fact, I was winning, earlier today, intraday. That's enough about account performance. I'm going to teach you now, or at least help you. Not even help you, okay? I just want to share, what I think is key to making money in the markets. Like, if you're just starting to make money in the markets or starting to invest, and maybe you've been in the game for 5 or 10 years and you still haven't figured it out, and I haven't really figured it out fully either, and I never will, and no one ever does completely. But here are some things that I actually created a sketch pad for you here. Here's some things that I figured out, right? That investing is kind of like a sport. I'm an athlete by trade, so I actually view it from a sporting perspective. And I really like this analogy that I've come up with, that different varying strategies are like different skills that you have when you're competing. So for example, let's take boxing, for example. Well, you have, you could throw a jab, an uppercut, whatever, a haymaker, all these different types of punches and movements. And those are skills that you have to practice in order to be able to employ them at the right time in a fight. And I think that there isn't much that's more competitive than the market, making money in the market. And so I think different environments call for different mastered skills, okay? Whether your skill is like dividend investing, and any one time you may need a mix, right? Whether you're good at dividend investing, you're able to identify healthy dividend paying companies that weather the storms of the economy well, or whether perhaps you are a momentum trader, how you can really smell like the next and upcoming company, and you're good at exiting at the right time, which is the key skill when it comes to momentum trading. Whether you're a growth investor and you're able to identify fast growing companies that are going to define the marketplace in the future, or maybe you're a day trader and you do technicals analysis or option trading of some sort, like the wheel strategy that I employ sometimes as well. And I think it's best that a fighter has numerous skills, excels maybe in 1 or 2 or 3 or 4 of them, but at least be aware of the rest of the types of investing, and maybe even do a mix of all these in order to diversify not only your positions, right, but the way you're approaching the market, the perspective that you're looking at, the lens that you see the market through. You can see it from different angles, and it gives you a better idea of how to survive and how to maneuver through this ocean. Just like when you see the water on the ocean, I like to compare it with the ocean for some reason. I have a bunch of ocean analogies that I'm not going to share, but only this one. So, when you're looking at the ocean and there's waves within the waves, if you ever stared into water for long enough, you see waves going one way, perhaps bouncing off the shore, bouncing off the bridge or whatever. And you see little tiny waves going across and over other waves. And then if you start looking further, you see that there's waves moving in all kinds of directions, right? From the shore, from a nearby rock, from a bridge, from like whatever. And they all form waves on top of each other. And I think that analogy reminds me of how like what would constitute like a successful portfolio, really. So what I've done here is I have put a list of 10 common investing approaches and styles that you could perhaps look through and see which ones you like. And what you can do is you can read some books on it. You can practice. Make sure you practice with real money, but small amounts if you don't, if you haven't mastered the strategies or the approaches. And then you can try to mix and match and see which of these is more applicable to the environment that you're in right now, in the markets. So I'll talk briefly about all of them. So first, indexing is pretty self-explanatory. Indexing is basically what every single 104 fund tries to do, right? Or a retirement fund tries to do. It's just, or financial advisors try to put you in is stocks, right? You just index in stocks and or bonds, and you just buy and hold and rebalance every year, basically. You don't need to know anything about investing. It's really easy, and it yields a historic average of anywhere from 7 to 11% a year. Obviously, there's, depending how you look at it, obviously there's down years and there's huge up years like we had in 2021. So, the returns vary. I recommend indexing to basically everyone. I think that if you hold 20%, let's say, of your account, or it can be 10% or 100% of the S&P 500 index, like by, for example, VOO or SPY or something like that. VOO is much lower cost, so I recommend that. And I think you're going to do just fine. In 30 years, you can come back around and set the dividends to auto reinvest, and you'll be rich. Just keep investing like a small amount of money each month, or a large amount of money, however much you can afford, or automatically deduct it from your check, and then you'll be rich. Promise. Guaranteed. All right. So that's one approach you can do. Then is buy and hold fundamentals. This is the approach that, I do some of this with Apple, for example. I've held Apple for many years now, maybe 3 years, 4 years, something like that. And I've sometimes increased, sometimes decreased the position depending on the markets, but it's a position based on fundamental, and it's a buy and hold position, right? I don't plan on selling it tomorrow or the next year or the year after that, unless something dramatically changes with the business. Like if somebody comes up with a better gadget that everybody has that replaces the iPhone, then fine. I'll consider, selling all of my Apple position. But it's called, it's one of my core positions, and I don't ever want to sell it. Kind of like Realty Income and Mainstream Capital for now. So something will have to dramatically change about these three companies, for me to sell them. Okay, third. By the way, Warren Buffett is a buy and hold fundamentals investor, if you're looking for someone. Number 3 is long short. Long short is a strategy that hedge funds like to employ. So basically what they do is they have a position and then they immediately hedge it with a short position. So for example, let's say you think the hedge fund might think, or you think, that Verizon is going to do better than AT&T in the long run or a short run. So what you do is you buy a Verizon stock and you sell short AT&T stock. All right. Now, when you sell short, be careful because you're responsible for the dividends that are being paid out by the company. So you have to make sure you keep that in mind. Also, selling short is pretty risky. You have to pay rent on those shares that you borrow so you can sell them in the open market. So be careful of that. Robinhood does not allow short selling per se. You can buy puts, but you can't really short sell. You can own short indexes, like inverse indexes, if you want to go take the opposite side to something. Like, let's say you want to be short natural gas, long oil, or whatever. I don't know. But you can do that with inverse ETFs, which I recommend playing with only with really small sums until you realize that they're only good for like short swing trades and not long-term holds. Moving on, so that's, hedge funds like to do long short, so there are many long short hedge funds. 4, global macro balance. So this one is really interesting. I do it a little bit because I buy things from, let's say, Latin America at times, and sometimes from like China, sometimes a European stock here and there, or a bank or something like that, sometimes US, or companies that are exposed to different countries. So I have a little bit of macro balance, global macro balance. And the way you make money is this way. It's basically there are conditions that are more favorable for some parts of the world than others, and so you try to balance that and buy the undervalued region and sell or not buy the overvalued region. So that's basically how you make money in macro balance. That's it. Somebody who does that sometimes is Ray Dalio, right? So 5, swing trader. Swing trader is basically momentum trader. Swing trades can be anywhere from like a week to 6 months. And you do your research, you find something that's going to move in the next 6 months, you pull the trigger, you either buy a bunch of stocks or you buy long call options, which is what people did with GameStop, with Tesla, the Wall Street Bets crowd. They're basically swing traders. So that's what it is. But you can just straight up buy the stock underlying stock, and then just without any options at all, and you'll still be a swing trader. Or you can even sell short for a week or 6 months, and that's also a swing trade, as long as you clear the position afterwards. Because if you don't, it becomes a long-term hold, right? And you need to be aware of fundamentals long-term. You can no longer rely on momentum. Number 6 is a day trader, forex, or technician. So this one is pretty self-explanatory. Those are all the guys that do videos and do like get rich quick courses and stuff like that, or like warrior trader. Like guys that make $400 into $300,000 in a year or something like that. So yeah, it's possible, but more likely than not, you probably lose your money doing that. The success rate for that is pretty low, and even if you succeed and you make a few $1,000,000, the market will change, so what you were doing stops working, and you will start getting slaughtered. So you have to be really careful, and don't think like, if you do decide to day trade in forex, make sure that you adapt and you change the way you do things based on what the market is feeding you. So you always got to evolve with the market. Okay, so just keep that in mind. And also, you can just do it as part of a combined strategy. Like, let's say you have your index funds that are going, you have your you have your dividend investments, and then you do some day trading or forex trading on the side, and that's fine. Okay, and hopefully one of them does well, over a certain period of time. So dividend investing is the next thing. This one is also pretty self-explanatory, but mainly going to be focusing on things like REITs and high dividend paying stocks. What a dividend investing really has to be aware of is how healthy that dividend is, and how likely it is that the company is going to keep paying this dividend over and over and over again. The unique thing about dividend investors is that they don't actually look at the price. They try not to. They do their best not to look at the price of the stock once they've purchased it. They rarely check it. Maybe if it gets really overvalued, they'll notice and they'll sell. But for the most part, they like to look at how much dividend they get each month and whether the dividend is growing or not. So they consider themselves successful by how that dividend is going, rather than what their total account value stands at. So it's very unique to dividend investors. And I also employ this strategy a little bit. I have plenty of dividend stuff, like Main Street Capital and Realty Income are both, REITs or funds that pay monthly dividends that increase every year. So ever increasing dividends, even through the great financial crisis, for Realty Income specifically. I don't know about Mainstream Capital, but which is very, very impressive. And it tells me that the people that are running this company can really go through many adverse scenarios. So I'm really confident in it. But my confidence should not be your confidence. You have to come through your own perspective in order to arrive to that conclusion, or not arrive to that conclusion. Also, the price you pay matters, and you have to beat inflation. So there's a lot into the equation. So don't just go out and buy Realty Income. All right, next after dividend investing is option selling wheel strategy. I also do this one as well. So I even have a video on the wheel strategy. I highly recommend you guys check it out. It's called like wheel option strategy or something like that. It's just my face with like black and white and says wheel option strategy up top. You can find it in the video. It's fairly recent. I did it maybe like a month or two ago. And then volatility arbitrage video as well. You can check that out. But basically constitutes of selling puts and calls of positions that you are going to acquire and that you have already acquired in such a way. And you basically collect premium from the movement of the market. Number 9 is diversification premium. So Mr. Ray Dalio again has said that the only free lunch there is diversification. So if you diversify really, really well, then theoretically you could survive many scenarios that hit the market sideways from unseen angles, and you'll still get some kind of premium at the end. So you could do this. I would suggest reading up on Ray Dalio's process and applying that to your own investment strategies if that lends itself to you. So that's another skill, another punch that you could employ in your fight against the market here. And then 10, I thought I would throw this one out, is special situation event trading, like for example biostocks. But it doesn't have to be biostocks. Like maybe something is happening to a company that, an acquisition, merger and acquisition, things like that, where it's going to be very volatile short-term movements. And you could try to really study up on that and try to take advantage of it. Like, for example, the most glaring, biggest example in biotech stocks is if a drug or some kind of treatment gets approved from the FDA's trials, maybe first, second, third trial, whatever, whether it's going to hit the market or not. And then you could theoretically, if you have some kind of insights, if you know a lot about, the medical industry or whatever, you could try to, if you think you have an edge, you could really make a lot of money there by, buying or selling one of those biotech stocks before or after, the announcement of their trial results. So there's a lot of money to be made there, and a lot of people do make money there. So that's number 10. So those are just 10 strategies, but there are more. There's factor investing, etc. Like there's many types of investing out there and trading and ways to get money out of the market. So I encourage you guys to look through some of these, figure out what speaks to you, and try to really look into them and employ them. Maybe you want to make like a soup or salad, a combination of these into your account to try to make sure that you increase its ability to survive. Like I think I really value versatility, and I think it's very important for making money in the markets. Okay, I'm gonna end it right there, under 30 minutes. So if you stayed this long in the video, like you're a freaking champ. I don't understand how you did it. So let me know if you watched the entire video, because that just like made my day. Write in the comments versatility below, so I know that you watched the entire video. So commend you on your efforts. Hopefully make another video tomorrow. Until then, peace out.